collection phase of the business process. So, as I told you, assertions never go away. And so, again, the assertions are the same regardless. And now we're just going to use those assertions or apply those assertions to the sales and collection cycle. So again, we have assertions about transactions and events, assertions about account balances, and assertions about presentation and disclosure. And so again, here are all of our assertions: occurrence, completeness, accuracy, cutoff, classification. So with the occurrence, again, what we're interested in ensuring that sales are not overstated. So the auditor here is looking to see that sales have been recorded actually occurred. The kinds of controls, so the auditor is going to look at the controls associated with the sales and collection cycles, and they're going to want to see things such as that invoices supported by customer purchase orders, bills of ladings or shipping documents, or other shipping documents exist for all invoices, right? Because you want to make sure that your sales are to bona fide customers, right? So your auditor is going to look to see that there are proper controls over the customer master file. That a sale that is recorded has been made to a bona fide customer. It's not enough that it's shipped, right? Because you could create a false or fictitious customer and ship something to that false or fictitious customer. So it's important to also know that it's a non-fictitious customer. It's a bona fide customer for that company. So the auditor would test those controls by getting a sample, taking a sample of sales in the detailed sales file and then tying those back to shipping documents, for example. So again, occurrence, you want to make sure that the sales that are recorded in the sales journal actually occurred. So your starting point will be the sales journal. Select a sample of sales and tie those back to supporting documentation such as the bill of lading. The other thing they would do is vouch the debits from accounts receivable accounts to supporting documentation or sales invoices, for example, because that would say that the customer, is it a bona fide customer of the company? The customer indeed placed this order. So you look at order entry documentation, invoices that you bill the customer for. Completeness, again, all sales that should be recorded have been recorded. So the auditor's concern here in testing controls will look at invoices, shipping documents, sales orders. They're going to want to make sure that they're pre-numbered. And pre-numbering is really important because pre-numbering establishes a sequence. So and this will be, and you'll see this when you start doing your ACL testing, right? You want to know, that's one way to determine that you have all items in the population. So for example, in ACL, you can run a test to see if there are any gaps in the sequence of sales invoices or checks or shipping documents. So the ACL will go out and look to see if there are any gaps in there and return a report of missing documents that the auditor would then follow up on. So you want to establish that there are no gaps in the sequence. That's one way of establishing completeness. But also, remember, the auditor would then look to see, okay, I know I'm going to select a sample of shipping documents, for example, bills of lading, and tie those back. I'm going to look at those shipping documents and make sure that that sale related to that shipment is indeed recorded in the sales journal. And then things such as accuracy would include credit checks. Credit sales are approved by the credit department. The prices agreed to the company's approved price listing. Again, examining the invoices for approval. So example, before in testing the controls regarding shipping credit authorization, the auditor might select a sample of sales or shipments and ensure that there's evidence that it was reviewed by the credit manager. So a signature by the credit manager. They might also look to see if they could run something, use ACL, for example, to run a script to see to see if there were any shipments or any orders processed when a customer was over their credit limit. So you could set the date range and see if there were any orders that were processed for customers over their credit limit. And that's a way of testing whether or not controls are operating effectively. Cutoff, again, relates to ensuring that the items are recorded in the correct period, so sales are recorded in the correct period. So you look at the date on the shipping document and compare that to the invoice date, for example. Classification, ensuring that sales are recorded in in the right account. So in other words, sales to customers should be recorded in sales. Other sales would reflect sales made to non-customers, right? So you want to make sure that sales are reflected in the correct account or expenses are reflected in the appropriate account. Any questions? So again, you see how we're using the assertions to develop the audit procedures. So in using, that's why it's important to understand the different functions and how those functions relate to one another, and then the reports and files that are used in testing or gathering evidence, so that you can, you'll know what documentation is necessary to be able to test management assertions. Then we have assertions about accounts balances. So the account balances that are related to the sales and collection cycle would be accounts receivable, cash, the allowance for doubtful accounts. Right? Those are the accounts in the balance sheet relating to the sales and collection cycle. So let's just look at, for example, accounts receivable. You're making assertions about account balances, so your assertions are existence, accuracy, rights and obligations, completeness, valuation, or allocation. So obviously valuation or allocation is going to deal with the allowance for doubtful accounts, and so the auditor is going to perform substantive procedures. And here I want to make a distinction. When we talk about transactions and events, notice the tests that the auditor is performing are tests of controls and tests of transactions. Right? That's what they're performing here. Because your controls are in place. Your controls are the process that the company has in place to ensure that that any errors or frauds would be detected on a timely basis. Right? So one of the things, if you're testing transactions, your transactions occur the same way all the time. Right? You don't have 15 different ways to record sales. You don't have 15 different processes over sales or over recording expenses. So if once you've established that there are controls over the sales process, right, then you're saying that those transactions happen the same way all the time. So if I'm satisfied with the controls related to the sales transactions, then I can just select a sample of transactions, test the controls over those transactions, and be satisfied that sales are proper. Right? I'll do some analytical procedures and so forth, but basically when you're testing transactions or looking at transactions, you are testing the controls over those.